Good afternoon. This is Jonathan Satovsky of Satovsky Asset Management, April 2019 with a video blog update. And today I wanted to talk about taxes, first quarter of 2019, and the persistency of factors in the market. So we'll start with taxes because April 15th is coming upon us and people are getting a bit surprised by the magnitude of tax obligations from their portfolios, and they're curious as to why would that be. Well, 2018 was an extraordinarily volatile year, and because of that volatility, there was a lot of rebalancing to keep people within their risk tolerance or risk bands, and that rebalancing trigger for many portfolios had created a larger tax gain than at mostly any time in the last decade for many investors. So with that in mind, we're mindful of system design architecture, of trying to think going forward carefully about each perpetual decision of the tax ramifications, not just in a short period of time, but over a long period of time, of how to design something to minimize that tax obligation. So first quarter 2019 was a tremendous quarter for asset classes all around the world. You can take the 6 broad asset classes and work toward cleaning up the clutter. This also will help in taxes over a long period of time. People own a lot of positions, some with major capital gains, but if you work toward cleaning up the clutter and working toward minimizing the number of positions that are held, we can work toward 6 asset classes. US stocks up 14% for the first quarter, international stocks up 10, emerging markets up 9, global real estate up 14, and bonds globally and in the US up 3%. So it was a great quarter for owning assets. The only hesitation I share with that is because the fourth quarter was so challenging, it was like pulling teeth trying to convince investors to save and invest going forward. People have been a little hesitant and, well, why would I invest now? It's obviously not a good time. You can see headlines over the last year. I mean, there's headlines every day that, will scare people. But if you zoom out over a longer stretch of time, just broadly speaking, you can see that taking a 5 or 10 year view, you increase and stack the odds materially in your favor of just owning assets. So now in thinking about that, how do we keep it really simple? How do we clean up the clutter? How do we work toward making it a little bit easier for people? I just showed you 6 broad asset classes, which we can work toward, in simple fashion, even though it's not as sexy to work toward a 60-40 portfolio or 70-30 or 80-20. Just the idea of having a globally diversified portfolio at a speed limit actually makes it easier for people to mentally understand the logic of how fast they want to go, 70 miles an hour, 80 miles an hour, 90 miles an hour. But digging one layer deeper, clearly if you own businesses, over time you should benefit. So the percentage ownership in equities should inure to your benefit, not all the time. You can see 1, 5, and 10 year performance of owning assets, owning equities over bonds, has inured to people's benefit about 85% of the time over 10 years. Leaning a little bit towards smaller companies has about a 73% probability of outperforming larger companies. Value has about an 84% probability of outperforming growth stocks, which actually has not been the case the last 10 years in the US. And profitability has a 99% probability of outperforming unprofitable businesses over a 10-year period of time. So if you're designing a portfolio, at least what we're working toward is trying to simplify, trying to clean up the clutter, trying to minimize the exposure to too much clutter, and focusing predominantly on the small, cheap, and profitable businesses. And over time, if we get that right and are mindful about taxes, then April showers of the tax bill will lead to May flowers of robustness ahead. Be well.